Everybody to today's webinar. I'm Grant Sheehan, CEO of the National Council of Firefighter Credit Unions. And this is our second webinar covering ALM and IRR, which is offered by TCT Solutions. Just to let you know, copies of these sessions will be available to you after the webinar for both you to review and to share with your staff. Today's session on ALM and IRR will be covered by Randy Thompson, PhD. He is the president and CEO and founder of TCT Solutions, which is a credit union CUSO. For those of you that don't know Randy has consulted with credit unions for the past 32 years. He holds an advanced degree and a PhD and MS in finance, statistics, economic, and public health. He's taught graduate courses through many universities in the Western United States. So let's welcome Randy, and he's going to kick off the webinar right now.
Thank you very much, Grant, and I welcome all of you to this session. You know, one of the things that I find is that interest rate risk does tend to become a little bit academic in some cases, and I hope to be able to overcome that a little bit and just bring it to a level where we all can understand what we're talking about. We're going to be doing a lot of practical kinds of examination, but I want to start out with a quick story. It's been about a year ago now, I was on a conversation of Zoom meeting. I guess we're all doing Zoom meetings now. This was predated COVID, but we were in a meeting with some key people from NCOA, Larry Fazio, head of examination, Tom Fay, the head of capital markets, and a few other people. And we were talking about methodologies and practices for helping credit unions better manage interest rate risk and make more money for their members. And one of the things that struck me when I was talking was that both Larry and Tom agreed with the comment that they made. That was, credit unions do not maximize their balance sheets. That's an interesting, banks certainly do. And we're not talking about charging fees. It's not the issue. Maximizing balance sheet is blending long and short-term loans at a level that gets the best return that you possibly can. And I know that there has been for years a reluctance with many credit unions, especially smaller ones, to get into longer term loans, longer term investments. Well, investments, I'm not all that keen on, but longer term loans can be very good in helping members in different ways. So really at the heart of this discussion is all about understanding and managing interest rate risk. So I'd like to do is spend some time today talking about some very practical applications. And we're going to talk about some differences between different ways of addressing that. So if we look at the screen, you'll see we're going to talk a little bit here. Let me make sure I've got it clicked on the right spot to go ahead and use these controls. Let's just talk first by what is risk. One of the things we do is a vital signs report, and it's like vital signs for your health, of blood pressure, 120/80. We know there's a range that you can be too low and you can be too high. Well, risk is exactly the same thing. The types of risk we work with, you can have too little and you can have too much, not just too much. You can actually have too little. And I find that there are a lot of credit unions that are extremely risk averse. So risk is not the loss. It's the possibility of the loss. And that may be nuanced a little bit, but it's a very important distinction. Because what we're in this statement, we're suggesting that some loss is to be accepted. Some loss is okay. Some loss is just the cost of doing business. We don't worry about paying our salaries to our employees. We don't worry about paying the lease payments to, or rent payments to, or licensing payments to our vendors. That's part of the cost of doing business. Well, guess what? In a lending business, the vulnerability to negative outcome is not eliminating the negative outcome. There's an amount of that that's appropriate. And that's what we're talking about here with risk. Risk is how exposed are you? Not are you exposed? Yes, we're exposed to a point where there may be some losses. Our job is to manage that to where it's not too low and it's not too high, either one. Now, when we talk about NCOA and we talk about managing a credit union, there are some very specific types of risk there. If you'll notice, the top two, credit risk, non-payment. Number two, interest rate risk. And I wanted to highlight a couple of things here that we're going to pull together as we move forward in this presentation. The risk that, if you look at this, the risk that your credit union won't adequately manage changes in market rates. Okay, that we know changes. We know that's the core thing we think about with interest rate risk, is that what if interest rates in the environment, Fed, or this discount window or the Federal Home Loan Bank, whatever you want to look at as your reference point, if they'll start moving up rapidly, what effect will that have on us? But here's the key that I want you to note. When they say these market changes, appropriate net interest margin or net interest income, the very definition that NCOA provides to us, that the Office of the Comptroller provides, that the FDIC provides to banks, the very definition of interest rate risk is measured by the impact on net interest margin. Now, that may not seem important now, but it will in a few minutes when we start looking at further definition and as we start adding or using some of our tools to see how to maximize that balance sheet, how to maximize and exploit is actually the term that's used, exploit that risk for the best interest of you, your credit, and your members. The more you do for them, the more valuable you are to them. So here we are looking about, we want to remember that if we're looking at interest rate risk, number one, there is an appropriate amount of risk, and it's not zero. And there is a measure for that risk on interest rate risk, and it's net interest margin, net interest income, synonymous terms. So if I were walking into your credit union as an examiner or as a statistician doing an examination, and I was looking at your interest rate risk, I would ask you three questions, and I would ask you, please consider these on a regular basis. These are extremely important, I believe. Number one, do you currently use an independently validated IRR measurement system? I'm sure that you probably do. Do you know how it was validated? Do you know how frequently it's validated? And when we say validate, to be valid is to say you are measuring what you say you're actually measuring. So do you have a validated system that tells you the impact on net interest margin? That's another question. Number two, do you and your board understand how the system works? Could you today sit down and do a presentation to an examiner, or more importantly, better measure, to a member and explain to them exactly how interest rate risk, your system works to measure interest rate risk of your credit union? If an examiner or an outside person, if a member came in and asked one of your board members, how does this work? Could they explain it? That's very important as well. Do you understand how it works? One of the reasons why I'm going to talk to you about NAV versus EAR, actually value at risk versus earnings at risk, as we talk a little bit more going ahead. And the third, and this relates to NCOA regulations. Do you consistently apply the system in the ongoing operation of the credit union? Do you run a simulation to test your budget? When you decide that you're going to add a new group of loans or grow a specific group of loans, do you run a simulation to find out if that's appropriate, if it'll have a positive impact on the credit union? Do you consistently use? Because, as we're going to see later in one of the regulations, NCOA says they expect that you will test the impact of new products on interest rate risk prior to implementation. Okay, so there's some of these factual things we're looking at. Now, if we talk about cash flows, remember there's loans, investments, and deposits. Don't want to spend a lot of time on these, but what's happening with loans, regular principal payments, is the cash flow. Now, obviously, there's some prepayments. People pay off early. They pay off, they buy another car and pay off the one they've got, or they may get some extra money in and come in and want to reduce their loan more rapidly. they turn a 30-year mortgage into a 15-year mortgage with early payments. Understand that. But the regular flow of cash from your members, reducing the amount that they owe on their loans, that's the cash flow associated with loans. Maturity, well, typically, most commonly, the investments, it's about when that that investment matures and the money comes back to you in cash that you can put into either another investment, holding cash, or put into loans. Deposits, that's all about withdrawals of money. And the interesting thing there is that unless it's a maturity deposit, well, let's just say any non-maturity deposit, the impact of interest on those is almost immediate. We'll look at that more in just a moment. So, as I said, there are two primary methodologies that are approved, all of them approved, or both of them approved for managing interest rate risk. I've spoken with the folks, like I said, folks at NCOA about earnings at risk. They're very supportive of it. They're back there. In the examiner's guide that came out 2 years ago, it says earnings at risk gets behind the numbers that value at risk cannot explain. I don't know how to better say it than that. Earnings at risk gives a better explanation of what's going on than value at risk is. So if we look at this interest rate risk, there are two groups. There's value at risk. I'll explain what that is in just a moment. Value at risk, and there's earnings at risk. Under value at risk, there is EVE, economic valuation of equity, which is what banks typically use. The application that was developed, it has a lot of bells and whistles, if you will, that are more applicable to banks and because of their tax status and the way they're allowed to operate. And then there's net economic valuation, and they were originally pioneered by Dr. Brick, that's used primarily by credit unions. Okay. The thing I wanted to point out here is there's not just one. NEV isn't the way. I know a lot of examiners will act as if that's the case, but NEV is just one methodology which has a lot of detractors, a lot of researchers and statisticians, and I can show you myriads of research that says it's not really reliable. It's actually counterproductive because, well, because of how it is applied. Earnings at risk, on the other hand, is a simulation that simulates the earnings of your credit union. So let's go to the next slide and just explain what I talked about. Value at risk, whether it be EVE or NEV, is based on one premise, and that is we're selling or liquidating your credit union. It's going away. So we're liquidating you. What can we sell your assets and liabilities for? What can we sell them for? And I'll show you an example of that a little bit later. In other words, if I've got 30-year mortgages, no one's going to pay me the full balance of those mortgages. I'm going to have to discount them because those people want to get their full return over the period of time. So they're not going to pay me full dollar for them because interest rates could be changing. They're going to cover themselves, and you're not going to get all the dollars. And so it's a sales measure related directly to your balance sheet. Let's stop for a minute and think. Net interest margin or net interest income. That's what NCOA's own definitions suggests is the key measure of interest rate risk. What's happening to net interest margin? NEV examines the balance sheet. Where on the balance sheet do you find the net interest margin? Quick answer. That's a secret, or that's a sneaky question. That's a trick question because it isn't there. Net interest margin is on the income statement. Earnings at risk, on the other hand, is an operational measure that looks at the ongoing value of your credit union based on the operational side, and it looks at your income statement. Oh, that's where that net interest income is. It simulates it. So it's an operational measure that assumes that your credit union will continue in business for the next 5 years and measures what impacts these decisions, these changes, or adjustments in rates will have on your credit union. Now, just to emphasize this, notice right here, all the way down. I'm not going to read all these to you. You don't see there, but notice it says that the role of the credit union, excuse me, is the boards and the policies is to determine all these things. Choose the test that you're going to use. It doesn't say set limits. For example, GAAP, NII, NEV. Doesn't say just NEV. Okay. Provide periodic review. Provide assessment of the, this is what I wanted to show you. Provide for assessment of IRR impact on any new business activities prior to implementation. So we're going to talk about those things today. So all institutions are encouraged to use earnings simulations. This is from the Office of the Comptroller of the Currency. That's the top dogs. And they're saying advances in technology have made simulation modeling more accessible for all institutions. So all institutions are encouraged. Doesn't sound like NEV is the answer. NEV is not earnings simulation. EAR is earnings simulations. Now we do a little both. So I'm not trying to push one or the other. I don't like the NEV. Doesn't work as well for what we're trying to do. Okay, so with that in mind, let me just show you a little bit of how this works. Earnings at risk holds the balance sheet static, establishes an amortization rate for earning assets. We look at the price elasticity of deposits, and then it simulates your earnings statement. Gives you simulated income statements for the next 5 years in our model, okay? And with that in mind, what I'd like to do is I'm going to come over here and let's look at the actual report. When we look at a report, what we see for a base case report, oh, wait a minute, did I? No, I moved over too fast. I apologize. I'm using a new, combining thing. So putting two things together. So let's come back over here just for a minute. I want to show you. There are two aspects to the system we were looking at. First aspect is measurement. Where are you now? What is your current interest rate risk? That's what all those NEV or EAR reports, those base case reports give you. Where are you right now? Okay, and that's important to know. But also we need to be able, if we're going to comply with that rule, to measure the impact of new business prior to implementation. We need to be able to do the second thing, which is how will proposed changes to the balance sheet affect interest rate risk? How will that do it? And we need to be able to know how that's done. So let's just look for a minute. I want to show you a very simple example of how interest rate risk works, what it does, how practical. If you see here, we've got a credit union. This credit union has about a $20 million loan portfolio, about $30 million of deposits, about $10 million of investments. And this is their yield. Right now, they're earning $275,000 a quarter in interest on loans, $37,500 investment income on investments, and they're paying about $27,375 on dividends. Dividends, that's good. I'm going to catch that. I'll have to fix that. Okay. We're assuming that interest rates increase 2%. So there's a 2% up shock. Environmentally, everyone's having to move up. And what we see over the first year, see those first 4 quarters of that year, from whenever it starts, whether it be first, second, third, or fourth quarter, it's 4 more quarters from there. We see that typically the loans will increase from 5.5 to 5.55 to 5.6 to 5.65 to 5.7. Stable kind of condition. I'll show you why that is in just a moment, and then we'll play with the tools. Next, investments. Notice they're moving up there gradually up to 1.8 by the end of the first year. So that's the yield increase. Cost of funds, on the other hand, increases 80, 130, 180. So they've gone up a full 2% in that first quarter. This credit union is heavily funded from core deposits, not much in the way of term deposits. Their maturity deposits are all short term, 1 year. So here we can see that the loan income increases from 275 to 285 per quarter. So there's a $10,000 per quarter increase in interest on loans from the first base quarter to the fourth quarter in the study. You can see that this investment income increases from 37 to 67. So there's a $30,000 increase. We have increased $40,000 per quarter in income from loans and investments. Now we know that net interest income or net interest margin is the difference between loan and interest income minus interest expense. Take it away. So let's go back and look at the second component. These dividends are going to increase from 27,000 to 209,000 because of the sensitivities of non-maturity deposits. Again, we're going to look at that in just a moment. So if we take 275 plus 37.5 and subtract 27,375, our net interest margin or net interest income, NII, is $285,000 in the base position. Now interest rates move up and the changes occur on these loans, investments, and deposits, and we see that the net interest income drops each quarter until it drops to $142,000. That's a 20% drop in NII. This is the measure that connects directly to what NCOA is talking about. So let's just see quickly where that came from. Simple example. You've got a loan that's made for $10,000 for 5 years at 2.99% interest. Okay, so there we are. I'm assuming that this, because of space, we're just going to have an annual payment. That payment reduces from the loan balance due to a payment reduces from 10,000 to 8,000 after the first year. So at the end of the first year, I pay my $2,000 back. See, there's been a $2,000 reduction in payment. During that first year, paying $299 on 10,000, I owed $299 of interest. But now I pay back the $8,000, the $2,000, and all I owe now is $8,000. See, there's that cash flow we talked about earlier, the money flowing back to the credit union. So now I only pay $299 on the $8,000. You can't change that interest rate. That's a contract for those 5 years. That's why it's slow to reprice, like we looked at. So now I pay $299 on the $8,000. I pay you $239. How about that other $2,000 that I paid back? I gave it back to you. I don't owe that to you anymore. Now you take that loan, that $2,000, and you loan it out to somebody else. But they don't get 2.99 interest rate. Interest rates have gone up 2%. They get 4.99. Oops, excuse me. So they're going to pay $499 on their $2,000. That's $100 a year. I pay $239. They pay $100. You now earn $339 on that $10,000 of loaned money. Now it's between the two of us. And now your yield is 3.39. See how it's just gradually increased. And it's very systematic step because the amount of repayment was consistent each year. The next year I pay you back another $2,000. I now only owe you $6,000. You're only going to earn $299 on the $6,000, but you now loan the other $2,000 out at the $499. And notice that that $4,000 earns you more money than the $6,000 does that I'm paying you on. The total is $379. The yield, I keep doing that. The yield increases to $379, and then $419, and then $459, until finally at the end of the 5th year, when I pay the whole thing back, you now have been able to loan the whole $10,000 out at the $499, and that's what you're earning. This is the half of the equation on interest rate risk. How quickly? Well, let me show you why this is important. You may have heard people say, oh, earnings at risk doesn't measure the long-term effects. That's not true. Let's say to measure that, You get a $10,000 loan for $299, but now instead of a 5-year loan, it's a 30-year loan. And notice here, there's very small amounts being paid back each year because I've got 30 years to pay it back. As a result, the amount of money you're loaning out at $499 is dramatically reduced. And as a result of that, your yield increases not from $299 to $499 over 4 years, but from $299 to $333. You don't even get to the $339 in that first 5 years. Now, I'm not trying to say that long-term loans are bad, but if all you had were long-term loans, that could be a problem. Okay? So we want to look at how do you maximize? How do you maximize that impact? So in a base case position, I just want to show you this as we go through. We're going to look at this credit union. Here comes their information. In the base position, they've got these loans, these types, with these balances, and this average maturity shows how long they're on the books. This is just like the 5 or 30-year example we just looked at. How long do they stay on the books? If they stay on the books for 26 months or 199 months, we can divide the balance by the term, and it tells us exactly how much, $2,333, how much is coming back each quarter and each year, month, quarter, and year to the credit union. Over here, we see the deposits, and we can determine how quickly we need to reprice them to be able to hold on to them and not lose them. We don't want those. That's our raw materials allowing us to make these loans. Okay? And then there's the investments. When do they mature? With this information in place, let's go over to page 4. The credit union then can say, based upon just like you saw us going from 299 to 339 to 379, moving up in 5 different shocks. We're just going to focus on the 3% shock right now. 3% shock. There's the base interest rate, the yield on their loans. And when that first, I need to go back. I'm sorry, this is not going to make as much sense if I don't do this. They've got $23 million in loans. This is that weighted average maturity. You can see they've got 5.7 of the 23 that is available to reprice in that first year. Another 5.7 there, 5.2913. There's $3 million that won't reprice. That's all part of that long-term loans that are sitting out there. But the blend is very nice. So now let's go back to 4. When that first 5.7 becomes available and can be repriced to a 3% higher interest rate, the yield increases to 5.94. And then when the next 5.7 million is paid back, the yield increases to 6.6. What we have here is a 5-year yield curve for the loans portfolio in this credit union's portfolio of loans. There's their yield. There's the yield curve in each year. Here's the yield curve when those investments mature. This is what the yield curve looks like for their investments. And if we go to the next page, as their deposits, maturity and non-maturity are repriced, you can see here how it reprices. And at this point, by the end of the 3rd year, all of their certificates, their CDs, member CDs are fully repriced, and that's where they're. So now we have, remember we said we hold the balance sheet stable for this base case report. We now can take these yields, multiply them times balances. Let's take a look. And now we have an income statement. This is why I like earnings at risk simulation, because this is something that your board looks at every single month, an income statement. They know what interest income is on loans and investments. They know dividend expense. They know net margin. They know other income. They have all these numbers. These are all based on your actual, no assumptions. On all that crazy, crazy assumption guessing stuff that goes in with NED. Here you have the base position, and as those yields increase, you can see the increasing return or income from those loans, return from the loans from year to year. You see the investment income, you can see the dividend expense. So now I can look at net margin. 1.3 is my net interest margin, net interest income, base position. 1.23, 1.28, 1.4. Now the question is not how much do I lose if I sell my credit union? The important question is, how long does it take me in a 3% increase in interest rates, a 3% upshock? How long does it take me to regain, to recoup? Basically, it's the tortoise and the hare. The hare is the dividend expense jumping out, and the hare is the interest income. How long does it take? Because the hare will slow down up here about 1 to 2 years out. And how quickly does the tortoise catch up and win? Or does it? So we have 1.3, 1.2, 1.2, 1.4, 1.6. It took it in the third year. NII caught up and started growing. And we're actually looking at this, it looks to me like a 3% upshock could be the best friend this credit union could have. Totally different way of looking at NII of interest rate risk, not how much equity do you lose. That's what the NAV number is. How much equity do we lose if we have to sell your credit union? But instead, given the structure of your balance sheet, how do your loans, investments, and deposits respond to that interest rate? And how long does it take you to regain and actually start building your net interest income? And as a result, what's your net income doing? Yeah, it's going to drop in that first year, and it's going to be lower in the second. But look what happens in the third, fourth, and fifth. So this is looking at that base position. Totally new way of looking at, and this, I think this is why the Office of the Comptroller says we encourage all institutions to use income simulation, because this mirrors what's actually happening. Okay, notice that in this case, I can tell you the NEV report on this says that in a 3% upshock, that they will lose almost 19% of their equity by having to sell things. But in this case, we can see that by operating the credit union effectively, there's no loss of equity. They're actually growing equity. That's where sometimes NEV, as the researchers say, this is not my quote, this is a quote from an international expert on interest rate risk, says NEV is counterproductive. It helps you make wrong decisions. Okay, so here we have this base position. That's really what I just want to start with. The base is where we're at. And if we look at this, now remember these numbers, if you will, 131, 123, 128, and 147. We go back 2 pages. We're going to talk about limits in just a minute. How do you identify and have appropriate limits? And I won't get ahead of myself there. But notice if I take, there's the 131, 123, 128, 147 on the last 2 years there. These numbers are just the net interest margin, net interest income associated with this credit union's current structure. I'll be darned. And now I can look down here and it says, well, if you drop from 131 to 1236, that is a 6% reduction, or 6% at risk. How much of your net interest income is at risk in a 3%, 1%, 2%? That's one of the reasons we do 5 different shock levels that can be built into the model. So you can choose and see what those ranges, what they're doing. But the real key question here is, how exposed are you? How is your NII exposed in these different rate shocks? Well, you're at risk. How much? Remember, exposure to risk. The amount of risk. We don't want zero there. When Larry and Tom said credit unions do not maximize their balance sheets, what they were talking about is there's a 20% limit that says we can take this amount of risk to serve our members, but that's all we're actually doing. sorry, not willing to go the full way that we could to help our members. Okay, so that number there, notice it drops to 2.4. And again, by the end of the third year, there's no NII at risk. It's starting to grow. I want to look at that period of time, what's happening. And I want you to understand this because we're going to refer to this when we run the simulation. So there we have these numbers. Here we are. I now can see that my interest rate risk is not excessive. I'm well under my limit. Maybe too far under my limit, but well under my limit. And then if we go back here, I can take my equity. I know that I made money every single year. It went down. I made less money in years 1 and 2. But in every shock scenario, other than, well, here, the down shock, my equity actually increases. There's no equity risk. If I sold my liquidated, there might be risk. But in the ongoing operation of the credit union, there's no risk. Equity's not, equity just keeps increasing. There's no 20% exposure. It's going up. So that provides, if you remember, we said in that one slide, measuring where you are now is the important starting point. But the other point that you need to be able to do on a regular basis is project how changes to your operations, new products, new buildings, new fees, new types of deposits, what impact they will have on interest rate risk. And really what we're really asking is, what impact will those changes have on your earning flow, on your net interest income? What's that impact? What's it going to do? How exposed are you? Well, what we need to be able to do there is to marry, I believe, or merge together two specific processes. One is, how do we look at this limit up here and make sure that's appropriate for this credit union? How do we know what that limit should be? I don't want to raise hands here, but I just said, how many of you are using today the limits that were established by NCUA, 35 and 40? If you are, why? Because they said so? Are you certain that that's the appropriate limit for you? Well, let me just tell you a quick story. Again, anyone who's watched me or heard me teach knows that I love to go to stories because I think they're illustrative. They give us some idea. I was sitting in my office. I've actually delivered training to NCOFCU examiners in about 7 states. I've been invited in to give training sessions, both state and federal examiners. And one of the participants from those classes called me it's been a couple of years ago now, maybe 2.5 years ago. I picked up the phone, pleasant conversation. He said, Dr. Thompson, I've got a question for you that I need your help. I said, okay, shoot. He said, I've got 3 credit unions that I'm working with. One of them has an equity ratio of 6.74. Prompt corrective action come to anyone's mind? 6.74. The next has an equity ratio of 9.36. And the third has an equity ratio of 12.36. No, 12.27, excuse me. So 12.27, 9.36, 6.74. And then he said, all 3 of them have the exact same interest rate risk limits in their policies. And then he asked the question, is that appropriate? Is that right? Can they all use the same limits? Well, I guess if they want to pull NCUAs in, they could. But is that really appropriate for each individual credit union? And my answer was absolutely not. So let's take a look here and see, how do we go about setting those limits? And I'm going to put this away, and I'm going to take you to our website, because those are the tools I have access to use, the only ones that I feel comfortable demonstrating. We're going to take a look here just to look really quickly. Now, as we get into here, I'm going to select a demo credit union. So we've set up demo credit union. And I'm going to go through just a few little explanation here. If you remember, one of the key, when we talk about equity, equity is very important. You remember that it's measured and it's a key element of the credit union. One of the reasons it's so important is because it is the measure of how much risk you can absorb. I'm a recovering banker, worked as a vice president of a large regional bank for several years before getting into the credit union world. And in that discussion, or in that time, I remember hearing the CEO of that bank say it is the responsibility of a banker, and I would say the responsibility of all financial institutions, to turn a profit. Why? Because from that profit comes the equity cushion that protects our members. See, if we didn't have that equity cushion, if we didn't have our allowance for loan loss as part of it as well, if there was a loss on the loan, it would come right out of our members' deposits. That would not go well. So by having that equity cushion, you have the ability to take risks, which is what we said we're supposed to do. It cushions that. And if you have more equity, you can take more risk. If you have less equity, you can take less risk. That's just categorically true. So what we want to do in setting limits is take a look at two important components. One is, what is your current equity position? And what is your net interest income? And by looking at that, what is the minimum amount of equity you're willing to go to? Appetite for risk. I'll explain that as we move ahead. So let's just say here at this point, this credit union says, I've got 9% equity, I think. So I don't want to put more than 2% of it at risk. That means I have 7%. We're going to do that in more detail. And I'm setting up these NCOA-based limits of 35% of NII and 40% of equity. All right? We're going to go over here. Let's use this to talk about how this all works. This directly related, connected to NCUA. So we're going to give it just a minute for the internet to catch up with us. There we are. You notice as of 6/30/2020, this credit union, this demo credit union, had 143 million and change in assets. At 18,000,005, almost 18.6 in equity, which is an equity range of 12.987. Now, oftentimes I hear the term thrown around, appetite for risk. And I will tell you, with most of the board members that I've talked to just off over different sessions, different places, that's a term that most of them just don't like because they don't understand it. Appetite, I know what my appetite is for fish and shrimp and steak and potatoes and those things, but I don't know what you mean by appetite for risk. Now, if we go back, it does make perfect sense if you think about it. The vulnerability, we say we don't want zero, but we don't want too much. So what they're really trying to say is, what's that range where it's not too much risk, but it's not too little? And right here, what we're saying, I like to do that is say, where are you now? What is your current equity ratio? This number is not real useful. Doesn't work real well at this point. We're going to use it later, but right now we need to say how much risk do we want to take? Well, what we ask is, what's the minimum equity position that you are willing to put yourself in? What's the minimum equity position that you're willing to expose the credit union to? And in this case, they say, well, we're willing to drop to 10. No, let's say 11. I've never had a problem getting that response from credit union board of directors. What's the minimum level? What's our minimum? What's our floor? Now we're willing to play around a little bit, but we don't want to drop below 11. I had one credit union say, don't want to drop below 15. Okay. When you're sitting on 18% equity, you can set a 15% floor. That's again, one of the reasons why the differences. So this credit union says we do not want to drop below 11%. If they dropped 2%, then I would put them under 11, put them at 10,987. So we're going to have to go back and reset this and only put 1.987 at risk. Notice when we say that there's that amount, okay, when we say that amount, it's easy then to calculate the dollar amount that's available for risk. Now at 2% of the equity, it's 2,000,008. Let's go back. Let's change this to 1.987. This is going to be 11%. And notice now with 1.987, my minimum equity is 11%, and now I have 2.8 million available for risk. So that's the first step. First step in trying to come up with an appropriate limit is measuring that appetite for risk. And that appetite for risk is really linked directly to what's that minimum equity position. We don't want to allow anything to get us down below 11. Great. That means we've got 1.987 available, which is $2.8 million. The next step is to take your annualized net interest income. And I prefer to use the most recent quarter because that's where you are right now. I don't want to worry about where you were 2, 3, 4 quarters ago because things could have changed dramatically. We had COVID, that has changed things. So we annualized that last quarter, come up with the total amount of net interest income. We then can divide the available at risk by the net interest income annualized to give us a number. That's the amount of our NII that we're willing to put at risk. But remember, that's over a 2 to 3, sometimes 4-year period. So we can't use that all in one fell swoop. So we're going to spread that out. The simplest way is divide it by 3 or 4. We use an algorithm, a statistical algorithm, to say this is where that division should be. And that says the maximum I should have is 23%. Now, that's kind of fascinating to think about. 35%, NCOA approved 35% based upon this credit union with over 12% equity. They should only put 23% at risk, or 24 if you want to round up. So accepting that number 35 without any kind of analysis for your credit union may be inappropriate. This credit union, if they put 35% at risk, they would potentially be dropping their equity ratio down into the 9s. Not good, not helpful. Okay, so now I can say my limit, I'm going to put 24, negative 15, because notice that 2.8 million is precisely 15% of the total equity. Where in the world does 40% come up with? Like I said, counterproductive. All right, my minimum equity position is 11. I now have the 3 key elements of my policy guidance, my policy limits that should be in my policy. And then this is proposed implementation date, let's say the end of the month. I can print a report. That reminds me, there's my numbers. And what I would propose, what I suggest, not propose, what I suggest, or I guess propose could be there too, for every credit union is that these should be revalidated every quarter. This process should be followed every quarter. Why? Because you could be changing, you could be earning more, you could be growing, and your equity could be going down. How many people have had massive inflows of cash during the last 2 quarters because of all the COVID-related issues? How many people are going to have problems moving forward with other kinds of issues? Every quarter, we need to be reevaluating or revalidating what our limits should be. And if you go 2 quarters or more with a 5-point or more different variation, it's time to go back to your policies. Isn't it nice to have a trigger that says time to go to the policies and reevaluate them, rechange them, not just when are we going to do it? So now if we go back to the other report, where do these come from? The 20% there, the 25% there. They're directly linked to the relationship between current equity and net interest income. If you have more and more high net interest income, you can take more risk. If you have more and more equity, you can take more risk. So that's the second step. First step was measuring where you are now. Second step is setting some limits for how far you can go. And the last step, I'm realizing that I am pushing my time frame here just a little bit. Let's go right over here. Is going to be measuring how can I change. Go back here to our simulation tool. And let's say I've decided we're going to create this. I'm going to add 3 million in real estate loans. What? I've spent too much time on stories now, but I can tell you every month I have clients calling me on a regular basis to help them run the simulations, or they just send me a copy of the simulation. They find out that, my word, I can put on $3 million of mortgages, which loans are available today, even at the 3.25% rate, and dramatically improve my earnings without exceeding my interest rate risk limits. So we're going to choose a demo client again. We're going to choose their base case. So we're starting from that report that you saw, or a report like the one you saw, that has that NII at risk and the equity at risk. We're going to create it. And then it says, okay, I want to add loans. Now there's a lot of things that simulations can do for you. You can change your investment mix, change the way that you weight the average life of loans, changing your deposits. There's about 13 different things that simulations will allow you to do. We have credit unions that run simulations when they're building a new branch or investing in a new course operating system, changing operating expenses, increasing or decreasing operating expenses or other operating income. All these things can be tested with a simulation. One of the reasons I love it, it's so robust. Okay, so we're going to just, for our purposes, we want to grow loans, which is the biggest issue facing most credit unions today. We're going to try it with long-term loans. So here's the loan portfolio. Here's where they are now. There's their balances, and there's their weighted average maturity. We're going to go right here and say 30-year mortgages. And there's going to be $3 million. And we're going to make them at 3.25. I forgot to do this. And they're going to have an average life of 145 days. Months, not days, months. Okay? So now I know in here what I've already got. I've got my base case report of what I've already, where my current position is related to interest rate risk. And it also is telling me what my earnings are and my equity is. It's got me a base case to work from. So now I'm going to click next. And this money that's going into these loans, is it going to come from liquid funds from my investment portfolio and cash? Or am I going to offer new shares to fund them? Or am I going to arbitrage from my lending? Well, for our purposes, we're just going to decrease investments. So now let's run that scenario. What we see on the top is the base case step shock, just like you saw before. This is it's a different credit union than the sample report that we looked at. I need to probably clean that up and have them both the same in the future. But you'll notice here, this credit union has a 21% limit. Notice that their base case is 20% NII at risk in year one, dropping to 14, break even, and positive. That number could look atrocious if that's all you looked at. But how about if we work through this and get to a 15% increase in net interest income by the 5th year? That sounds pretty positive. Equity at risk, a little bit in the first year because they're going to lose money there. But when things start rebounding, they start gaining that money back. Now, this is without putting those $3 million of loans on. That's the base case. This is that first measure. Where are we now? What's currently happening? Now, if we add those $3 million of loans, and that's why we have this page, you've got where we would be without them. Well, where will we be with them? $3 million of 30-year mortgages, look here, not much increase in the NII at risk, not much at all, and still under the 21% limit that they set. Here, a little bit higher, and then they're following along here. How about equity? Well, here they had 35 basis points at risk, here only 12. Why? Because this $57,000 loss gets reduced to a $21,000 loss. And notice here, in year 2, their earnings are actually higher. Year 5, you get a $9,000 improvement in their earnings, and their equity is actually higher. So, good idea. I can tell you that I've had clients who have gone in and said, we're going to run a simulation on a $700,000 mortgage, 30-year mortgage. They printed off the report. I'll show you an example of that in just a second. And they put that in the file with the loans. The examiners will come in, pull open those mortgages, look at the report, see the results, put them away, and move on. So is this something you want to do? Well, looks like it might be a really good idea. So what we do is we print the full report. There's the increase in yield on loans. Remember, we put this in at 3.25 interest, not 4.25, not 5.5, 3.25 current interest rates. And it does not. Why does it not exceed your limits badly? I want to come right over here to this page, right? Oh, did I go too far? Well, we won't worry about that right now. It's because right here, sorry, I did go, because of this $112 million, $113 million, even with the new 30-year mortgages in, okay, $18 million is repriced in the first year. They had too little, remember? Way too little interest rate risk to start with. Now they're exploiting it. Now they're maximizing it. And by doing so, they're improving the equity, they're improving earnings, and they're able to offer mortgages to members that would have had to go on somewhere else. Okay, all this stuff fits together. All that makes sense, I hope, as we look at it. I want to just kind of conclude because we're right at our ending time. I'm going to conclude with this. Remember, do you currently use an independently validated system? Make sure you have that validation in place. Number 2, if you sat down with your board members, or if a member who sat down with the board member, can the board member explain exactly how your system works? If they can't, then how valuable is its input to them in making decisions, to you? And thirdly, when you run new budgets, new plans, when you have new products, when you change promotions, when you add new anything, are you consistently applying the system to the ongoing operation of the credit union to determine the interest rate risk prior to implementation? That's the exact words of the regulation. Okay, well, like I said, I've expanded my time, used every second of it. I apologize for going just a tad over. Thank you so much for spending time with us today. I hope this has provided you with some things that are interesting and useful. If you'd like to have any more information from us, this is our contact information. Donna is amazing and she's fun to talk to. So if you want to give her a call or send her an email for more information, we would welcome the chance to talk with you more. Grant, I'm going to turn the time back to you. Again, thank you so much for allowing us to be part of your wonderful association as partners.
Well, Randy, we want to thank you very much for the time that you've taken to explain all this to us. I know it was a lot to try to get in. Like I said, the session has been recorded and will be available to you at your leisure to review. And if you have any questions, just give Randy or Donna a call. Thank you very much for attending, and we look forward to seeing you at our next session. We will be announcing that shortly. Thank you all for coming.
Stay healthy.